everybody. It's Mike Preston at New Harbor Financial with a weekly update. It is Wednesday, December 20th. It's a lot going on in the markets. The markets have continued unusual strength over the last couple of weeks. We've been concerned about a continuation of this for at least the last month or so. We've been talking about how our short-term indicators were showing improvement a couple months ago. That caused us to reduce our hedges and add a little bit to our stock exposure. However, other things about the market certainly worry us about, for instance, the record overvaluation and the fact that the market has been pretty narrow over the last year or so. The narrowness has changed. We're starting to see more participation across the board in small caps, mid caps, in other stocks other than the Magnificent Seven. Few things I wanted to share with you here, and I'm going to bring up a few charts. First of all, take a look at this. This hit the news the other day. The largest ETF in the world is SPY, which is the S&P 500 ETF. And to say that bullishness is a little bit overheated is an understatement. The SPY ETF saw the largest inflow ever. This is basically the world's largest ETF. Saw the largest inflow it's ever seen. I know this chart only goes back 4 years, but I have to take my word for it that this is the largest inflow ever. So much so that the ETF had to create a record number of shares or new shares to accommodate. Now, this is a sign of short-term confidence, short-term over bullishness. It doesn't really mean anything, though, in terms of being able to call an exact turn. We absolutely have our concerns about overvaluation. We definitely have our concerns as well about the market running too far too fast. But at the same time, we think that it's likely that we may be in, and probably are in, a blow-off top here. And there's no telling really how far it can go. I want to share a chart of the S&P here on a bar chart. Take a look at this. This is SPX, so the S&P 500. Back when we were threatening to break this downtrend, we became concerned that we were going to get some type of one more move up or a blow off top. And nobody knows where this is going to end, but this has been a pretty historic move. There's been almost no down days. The Dow just hit, I think, 9 record days in a row yesterday. This is the S&P, but we had this breakaway gap back here. After it looked like we were going to have a move up. At the same time, our short-term indicators were moving higher, and we're short-term bullish. So what we did is we had an in-the-money put for about 15%, and we took that off. That was the December 4,500. We took a profit on that, and then we established a January 410, 4,100, and now we have a March 4,100 on 15%. That's just in case we get a crash. At some point, we're going to get a crash. We just don't know when. But by moving that hedge, we were able to preserve value and performance in the account. But take a look at the RSI. The bottom of this chart is the relative strength index. So the RSI is very overbought here. Now, that doesn't mean much of anything other than at some point it's going to reverse. On the daily chart, it's overbought. On the weekly chart, it's not quite as overbought. And on the monthly chart, you might argue that it's got room to go. So it all has to do with your time frame. But, with this cup and handle and now breakout on the monthly chart of the S&P, until we get an actual reversal, there's no telling how far it can go. So we've been relaxing our hedges, and we've been picking or finding other sectors to participate in. Let me just show you a couple of the things that we've been doing. One sector that we added a few weeks ago is insurance. KIE is the insurance ETF. It's done well, had a little bit of a reversal here the other day. But, we're in that. It's a small position, 2.5% or so. We've been in industrials the last couple months. Several months actually. Industrials is one of the nicer looking charts. We've got a 5% position. We just sold calls the other day. These industrials moved to a new year high. and they tend to be a bit extended. And we are concerned about some kind of reversal in the near term or pullback on the S&P. And also on the equal weighted S&P 500, we noticed that the equal weighted S&P 500 was starting to participate in the rally. And, we noticed this back here. So for the longest time, the S&P 500 was outperforming the equal weighted S&P 500, but the breadth started to improve, and then the equal weighted S&P started to participate. So back here, before this big move up, we bought an in-the-money call option expiring a couple months out for 10% of the portfolio. So now this particular call option lets us limit our risk for the premium that we paid, and yet it allows us to increase our equity exposure by 10% in an area that's starting to participate. So if we get a continued blow off here or a move higher, this helps us increase our equity exposure. Our equity exposure nominally is only, in the mid 20%, but by adding this, it brings us up to the mid 30%. Let's call it 35% or so. Uranium we have as well. We did just sell that because the call option expired deep in the money. We're evaluating perhaps putting it back on here. I know that it's, relatively short-term trading, but if we can add some value by selling on a spike and buying back a little bit later, we'll do so. We may be putting uranium back on in some way very soon. Let's do a quick review about on a couple other things. Long-term bonds have been absolutely hammered over the last year or two. It's been a painful trade. We were able to hedge out some of this decline, but now we've had a big rebound in long-term bonds. We did sell half the position because we had it written. We have the other half of the position hedged. We think that we're likely to see a pullback here. Yields went very quickly from 5% on the 10-year to under 4, 3.9 or so. Wouldn't surprise us to see yields move back to 4.5. That would mean TLT coming back to 92 to 94. And so we may very well add back on that other position while we work the remaining half position that we have. And so, bottom line is we just don't know how far things can go. And we're going to do our best to ride it and not get caught in the reversal. But the key is that we've got 30-something% equity exposure and still close to 40% treasury bills. Our model has had an excellent bounce the last month or so. A lot of you that are clients, I'm sure, have noticed that. We're happy about it. It wasn't fun a few months ago when both long-term bonds and gold mining stocks were getting hit. It was a little bit of a rough patch, but things are a lot better now. We're continuing to scour for charts, always looking for good setups. A lot of what we do is technically based. We're looking for strong sectors, and then we're looking for good chart patterns out of bases that break out. That's why we added insurance. That's why we added industrials a while ago. That's why we added the S&P equal weighted, because we noticed that its relative strength was starting to improve. So we'll continue to do that. And I suppose I should end this with maybe one more chart. Just take a look at gold, because I don't want to forget gold. The charts are quite good on gold and silver, yet frustrating in a way because they've yet to break out. If you take a look at silver, I will change the symbol to silver here. So here's the daily chart of silver. It's been flirting with this downtrend line, this triangle, so to speak. Let's zoom out to the weekly. It's a big triangle. Broke out here and then failed, which was frustrating, but it's had a nice reversal the last couple of weeks. Take a look at a monthly chart. Let me zoom in a little bit. We're essentially there. What I'd like to see is one big bar on silver. We'd have to have, a big move up, and that would likely come when gold breaks through its ceiling. Take a look at gold here next. Gold has been flirting with this triple top. We know it's going to break it. It actually broke it in the futures market a few weeks ago and then reversed. Now, nothing's guaranteed, but it looks to us like it's going to break it. It has an inverted head and shoulders pattern. If gold breaks out higher, it should drag silver up with it. And then hopefully, finally, the gold mining stocks would do the same. Let's take a quick look at I'll zoom into a daily chart. This is the junior gold miners index. It is really close to clearing this point here, which would be a breakout. On a weekly chart, you can see this 4-week consolidation. If gold moves higher, these should break out. GDXJ should move higher into the 40s, for instance. These are just examples and certainly not recommendations. These are just our opinions. GDX itself, sitting here at 32 or so, should move up into the area depicted by this line, at least 33, 34, and then ultimately higher, high 30s, if we get a breakout in gold. So hopefully we do, and we'll see. We'll see. Gold has been flirting with that level for a while. It's stuck at, I guess, $2,030 on the spot market, but we don't know what the catalyst will be, but we hope that we are right and that it does break higher. Near term, though, as a recap, looks like the market wants to go a little bit higher. It's definitely overbought, overloved, over bullish, but we're not fighting it. We're going to try to ride it for at least a piece of it. And we've got our hedges on, and we look for better opportunities down the road to get more bullish with equities at lower prices. But we're not going to get, I wouldn't expect we're going to get very bullish until we see much lower prices. So we'll be updating you every week. Thank you so much for watching our recap. And again, this is Mike Preston with New Harbor Financial, hoping to bring you fundamentals and data and insight every week that you can use and act on. Any questions, please let us know. And until next week, thank you.